Welcome back to Midcap Radar. Well, the company in focus is EPACK Durables. The company's expenses rise offset the revenue growth of the company declined as well. To discuss the quarter gone by and the way forward, we are now joined by Ajay Singhania, the MD and CEO of EPACK Durables. Good afternoon, Mr. Singhania. Thank you so much for joining us. As far as H1 is concerned, you've seen very strong revenue growth. How is H2 shaping up, and what are the targets that you have set in terms of guidance that you can give to investors for the revenue, EBITDA margin, as well as bottom line?
Thank you. First of all, good afternoon, everybody. See, H1 performance, as we have seen, has been phenomenal with an aggregate growth of almost close to 85% plus and EBITDA growth of almost 65% plus. So overall, if we look at H1, it has really given us good amount of confidence that our previous commentary of growth of 50% plus for the entire year is on track. And for H2, we'll continue the journey. We have a very strong book going forward, both for Q3 and Q4. So overall, in terms of the entire financial year 24-25, we are looking at 50% plus growth for the entire year. And in terms of the EBITDA margins, we continue our stand that overall EBITDA margins would be at similar level what we had achieved last year. So both are on track, and we see that all the steps and efforts we have done in the previous year have started paying off the results. So the revenue growth is something we had lacked last year, and the efforts done have definitely paid us forward.
Okay, you know, your total expenses have been quite high this time around, Mr. Singhania. What explains that increase, and is it something that would cool off in the coming months?
So definitely, see, one expense increase has been can be attributed to two things. One, we are gearing up going forward for H2, and the recent capacities we have created, especially the South plant in Surrey City. So that's got operational only in January. So obviously, first H1, the utilization has been extremely low to the tune of hardly 10%. Now going forward, as the utilization improves, a lot of the fixed costs starts getting utilized. And on top of it, since we are also launching a new segment of products like washing machines and others, so a lot of costs attributed to those new developments have been built into, and as we start utilizing those capacities, we'll see all that cooling off.
Okay, Mr. Singhania, talk to us about your plans as far as the sales mix or the revenue mix is concerned. We understand that the RAC segment continues to contribute majority of the top line. By the end of FY25 and by the end of FY26, how will we see the sales mix as far as EPACK is concerned?
See, currently, obviously, AC contributes almost close to 80% plus of our revenue, and the non-AC business is 20%. This year, because of a significant increase in AC, I mean, AC growth being the market growing at 40% plus, so that definitely has overshadowed the growth in the other directions what we have done. So probably within even this year, AC will still continue maybe 80% plus of our overall revenue mix. But going forward, we are definitely consciously putting a lot of efforts to diversify our product offerings. So like we started coolers. Now, washing machine is something which will start getting rolled out from next month onwards, and then other small appliances and the component business, the EMS opportunities, what we had made an announcement in the previous month. So all those opportunities will start showing off in the results from FY26 onwards, and we definitely see that despite substantial growth in AC, the overall revenue mix or dependence on AC will start coming down. So in a slightly longer term horizon, we are looking at somewhere between, let's say, 60% on AC and 40% non-AC.
Okay, 60% AC, 40% non-AC. You had told us that washing machines could be added by September, October. Are you saying it's been delayed now?
No, so we are on track. We said October the pilot production. We already did the pilot production in October, and end of November is what was targeted as the mass production. So we are on track.
Okay, and what about the other products? Anything that will be done in this fiscal itself, since you're saying majority of the benefit will start coming in from FY26?
So other products like on small appliances side, especially the air fryers are now ready, and Q4 we will see air fryers getting productionized. So that's something on the new product side. Cooler business ramping up very fast. So cooler is something like probably we are the doubling this year and then again doubling next year. So cooler is seeing a lot of traction for us. And then even the product range for our washing machine, which we're starting up with the fully automatic only, then going forward semi-automatic and other SKUs are getting added on. So a lot of new developments in pipeline, which we'll see giving us results in FY26.
Okay, we also want to understand about the strategic cooperation agreement that you have with Hisense. What is the revenue potential over there? When does it start trickling down into the top line as well as the bottom line? And also, as far as FY25 is concerned, what is the target that you have in order to go ahead and onboard new customers?
First of all, talking about the Hisense agreement. Now, Hisense is a very strategic joint venture wherein EPACK is investing in creating a dedicated facility for Hisense India. And this facility would be established in phase one to cater to the requirements of air conditions, and then going forward, other appliances like refrigerators and all. Whereas for washing machine, we already have the capability which has been approved by Hisense, so that would be catered from our current facility. So we are contemplating or we are targeting to start production from end of June. July first week is the target date to start production for AC in phase one. And within 3 years, the idea is to ramp up the production to almost 1.5 million for Hisense. In 5 years, the projected revenue from both air conditions and washing machines is estimated to cross almost $1 billion. So that's 8,005 years from these two opportunities. And as we add other appliances like both small domestic appliances and refrigerators, etc., going forward in next 2 to 3 years, that scale and the revenue would further increase.
Okay. All right, Mr. Singhania, thank you so much for joining in and giving us all those details. That's the word coming in from EPACK Durables. In the